Hi everybody, George Chamberlin here, watching your dollars on this Monday, the 12th of September. Hope you had a good weekend, lots of exciting football going on, and of course a wonderful weekend of remembrance of the tragedy of September 11th, 2001. Very emotional, very moving stuff going on. I want to talk about interest rates today because we are in a very interesting situation here with the economy the way it is. Interest rates need to be very low. Come on over, Mike, and we'll take a look at this chart of interest rates. This is a chart that represents the rate of return on U.S. Treasury obligations. And this is the short end as far as maturities are concerned: a 3-month Treasury bill, 6-month Treasury bill, 1-year Treasury bill. The interest rate on 3-month Treasury bills, 6-month Treasury bills, and 12-month Treasury bills, zero. You earn absolutely no interest. Now, as the maturity line goes out further, interest rates start to go up until you get all the way out here to the 30-year U.S. Treasury. It's yielding, what are we looking at here? About 3 3/4, 3.75%. Not very much in the way of return, especially if you're committing your money for 30 years. The situation is that short-term rates, as the Federal Reserve has told us, are going to stay very low until mid-2013. This will not change. Theoretically, these rates could move higher in here, but it's still a very appropriate, that's called the yield curve from short to long. The longer you're willing to lend somebody your money, the more interest you will get paid during that period of time. And so you can kind of see what we're working with in here. It's an interest rate curve that is symbolic of a very, very troubled and weak economy. Ideally, you need to see some inflation. You need to see short-term interest rates up from where they are. Not very much, but up in the 2% range is probably normal. And then you would see the long-term rates around 4.5% to 5%. Normal. We're a long way from that. We're probably not going to see that anytime soon. And with interest rates as low as they are, you wonder why more money isn't flowing into the stock market. Where's it going? Historically, over the last couple of years, it's been going to gold. By the way, I took a look at the price of gold on September 11th, 2001, and it had a big spike up after the attacks. It was at $285 an ounce. Today, it's at $1,900 an ounce, 10 years later. Watching your dollars, I'm George Chamberlin. Have a good one.